Donald Trump's $2,000 dividend might really be happening. What does that mean? Who is eligible to receive the dividend? And how will that affect the market and your investment? Let's break that down in this video. So the basic promise is this. President Trump said the US is collecting trillions of dollars from tariffs and that some of that would be returned as dividend refund checks starting in 2026. Economic advisors then went on TV and made it clear this is not for everyone. They've said repeatedly it would be targeted to low and middle income households, not high earners. The income line they keep hinting at is around $100,000 of annual income. A team at the Yale Budget Lab gives the most detailed public modeling so far. In their version, the tariff dividend is a one-time $2,000 refundable tax credit per person for tax filers with adjusted gross income below $100,000, with no phase-out and no limit on how many people per household qualify. Under that kind of design, here's who would qualify. A single filer making $60,000 gets $2,000. A married couple making $95,000 with 2 kids, all 4 qualify, so $8,000 total. A single parent making $40,000 with 2 kids gets $6,000. And here's who wouldn't qualify. Anyone with AGI above $100,000, high-income households, even if they have kids. People who don't file taxes or otherwise aren't in the system unless the final law builds in some special mechanism for them. So when you see $2,000 for every American, mentally translate that to up to $2,000 per person. Only if your income is under a cutoff politicians still need to finalize, likely around $100,000, and only if Congress actually passes it. What has to happen legally for these checks to exist? This is where it gets messy. First, Congress has to play ball. The director of the National Economic Council and other officials have already said in interviews that $2,000 tariff checks would require legislation. Second, there's a giant legal cloud over the tariff revenue itself. A big chunk of the current tariff regime rests on emergency powers and is being challenged at the Supreme Court. If the court limits those powers or strikes down some tariffs, projected revenue could fall by more than half. Third, we already have a real-world case study, the so-called 1,176 Warrior Dividend, for service members that the administration just announced. Trump publicly said this was funded by tariffs, but reporting shows it is actually coming out of pre-approved Pentagon housing funds, not tariff revenue. So even when the branding says tariff dividend, behind the scenes it's still normal federal spending, shifting money around the budget and/or borrowing more. What could this mean for markets if it passes? Now the fun part, what this could do to stocks and your portfolio if Congress actually approves some version of the tariff dividend. I'm going to split this into near-term and medium-term effects, and I'll throw in actual tickers you can research. Not go buy this, just this is where the impact shows up. 1. Short-term checks are coming trade. If markets start to believe that $400 to $600 billion in one-time consumer cash is really landing in 2026, the first order effect is a bump in consumer spending. That usually shows up in big box and broad retail. Think WMT, TGT, Cost, AMZN, Low. These benefit when people have extra cash for groceries, household upgrades, and impulse buys. Consumer discretionary ETFs. Things like XLY or XRT typically catch flows when people expect stronger U.S. consumption. Travel and leisure. Extra $2,000 means more people booking flights and trips. DL, UAL, LUV, MAR, BKNG, ABNB all live in that ecosystem. Restaurants and treat-yourself names MCD, SBX, Yum, CMG, and similar benefit when disposable income gets a temporary sugar high. Payment rails. Every extra swipe runs through VMA and sometimes PYPL or SQ. Those don't care what you bought, just that you bought something. You're basically looking at a mini stimulus check trade, just smaller and more distorted by tariffs and inflation than the COVID round. Small and mid-cap domestic stocks could also get a sentiment boost since a lot of that spending stays at home. 2. The tariff side of the story. Now the not-so-fun half, tariffs themselves. If Trump cannot get enough money to fund his dividend, that means even higher, broader tariffs hit companies that import a lot of goods or components, especially from places targeted hardest. That usually pressures import-heavy retailers and apparel. Names like GPS, Rost, TJX, URBN, NKE have complex overseas supply chains. They either eat some of the cost in margins or try to push it onto customers. Multinationals deeply tied to China and global supply chains. AAPL, TSLA, NIO, tech hardware names, consumer electronics brands, automakers like GM and F all have varying degrees of exposure to imported parts and retaliatory tariffs. Emerging market into China ETFs, Funds like EEM, FXI, or MCHI tend to suffer when global trade tensions ramp up and the US throws around broad tariffs. So even if the $2,000 checks give US demand a short-term pop, the structural headwind from tariffs still hangs over trade-sensitive names and anything heavily reliant on imported goods. 3. Bonds, rates, and the "this isn't free" part. Because almost every serious estimate shows the dividend costs more than the tariff revenue, this isn't actually self-funded. It likely means more deficit, more treasury issuance, and at the margin, some upward pressure on long-term yields. From a portfolio angle, that usually plays out like this: treasuries and bond ETFs. If yields drift up, short and intermediate term funds like SHY, IEF, or VGIT become more interesting from an income standpoint. Long duration like TLT gets more volatile, more upside if yields fall later, more pain if they keep rising. Rate-sensitive growth stocks, high multiple tech and story names tend to hate rising real yields. A one-time consumer boost might help revenues, but higher discount rates pressure valuations. Value, cash flow names, companies with solid cash flows and reasonable valuations usually handle modestly higher yields better than profit in 2035 growth plays. So what should retail investors actually do with this? Here's the boring grown-up summary. You're welcome. As of now, the $2,000 tariff dividend is not law. It's a political proposal facing legal uncertainty around the tariffs themselves, budget math that doesn't really work, skepticism inside Congress, including from Republicans who'd rather use tariff revenue to reduce the deficit. If some version passes, it is likely to be targeted at low and middle income households. One time, not guaranteed to repeat, a modest macro boost, not an economic miracle. For markets, the reasonable base case is a bit of extra juice for consumer-facing sectors in 2026, ongoing drag from tariffs on trade-sensitive and import-heavy businesses, slightly higher long-term debt, and modest upward pressure on yields. If the dividend actually lands in your account next year, that's bonus capital. Use it to strengthen your balance sheet, pay down high-interest debt, beef up your emergency fund, or invest in long-term assets instead of chasing whatever meme stock is trending that day. No, the government is not magically turning tariffs into free money. It's more like they're taxing you in a less visible way, then maybe giving some of it back in a very visible way. As always, wealth takes time.